Some interesting breaking news this morning. Berkshire Hathaway now sitting on nearly 300 billion, yes, with a B, billion dollars of cash, according to what Federal Reserve Chairman Powell said in Jackson Hole. It sounds like they may be lowering rates in September. Most importantly, though, what does all this mean to you and your portfolio? We're talking about that and more today here on the Commercial Real Estate Report. I'm your host, Chris Berg. Very special guest joining us today. He is the author of this book called The Secret Wealth Advantage. He does an incredible job laying out in this book the 18.6-year real estate cycle. What I really, really like about this book is the fact that it's very systematic the way he does it. And most importantly for me, simple. Even where I'm like, okay, I see the trends now. I can make some decisions here based on this cycle, some very powerful decisions at that. He's also a co-managing director at Property Sharemarket Economics. Akhil Patel. Akhil, it is great to have you here, and I'm very excited for this conversation.
Thank you very much for having me, Chris. I'm delighted to be on.
So I do want to get into the context of, Berkshire now on $300 billion of cash, the potential of lowering rates. 11 out of the 15 times the Fed have lowered rates, we've gone into recession. I think your thesis says something different. Before we get into all that, which is going to be great, just for people that aren't familiar with it, give us a little bit about your background and really the inspiration and the impetus to your book.
Yeah, so I didn't study economics. I've in fact not had a single minute of formal economics training. You might ask why I'm writing a book that is fundamentally about economic cycles. So I came into this in the kind of late 2000s after the global financial crisis. And my family's business experienced a very difficult time. They were in pharmaceutical wholesaling, were reliant on bank credit. The banks withdrew their funding from small businesses like ours. It almost kind of caused us to go under. It forced us into a merger with a larger company, which actually ended up being a really bad decision. And it was a pretty bad time. And I just thought, this is such a significant event. It's had such difficult consequences for my family and a lot of other families. And I couldn't understand, that we weren't prepared. And so I decided I was going to look into it. I was very skeptical of what I was reading in the newspapers. They were explaining all sorts of different ways. My sort of academic background is in the classics, which is, for those of you who don't know, it's sort of ancient history and philosophy and literature and so on. And I think the relevance to kind of the economic situation is that you tend to see the world in patterns and long-term patterns. And that's what got me into cycles. I came across some people who talked about how you can actually predict the course of the economy. And I thought, that's very interesting. And so I looked into it further. And because of my background, I was quite open to the idea. And the more I looked into it, the more sort of impressed I was by how much you can actually forecast in an economy, not, day to day, but the longer term trends, which are really the key things for big decisions you make as a business owner, when to invest, when to sell, when to buy, and so on. And also as a investor in your own assets, when to buy property, when to buy stocks, when to sell them, when to hold, how to hold, et cetera, et cetera. So I kind of felt this was the kind of body of knowledge that I wished I'd had, I wished that my family had had in the run up to the financial crisis in 2008.
It has been incredible, Akhil, because obviously I was originally introduced to Phil's book, The Secret Life of Banking and Real Estate, and then yours. And I continue, because I don't want to be a lazy thinker, so I'm continuing trying to poke holes in your guys' thesis. Yeah. And every time I do, it's like, no, it's lining up. It's lining up. And so before we jump into more of your thesis, I just want to share with the audience so you can kind of share, obviously your epiphany that you have, but also you open your book up with a great story about the Queen coming down to sort of her economic team going, hey, how did nobody see the great financial crisis coming? Just share that story quickly.
Yeah, so she went to the LSE on I believe it was the 5th of November, 2008. So it was about 7 weeks after Lehman Brothers had collapsed. And, the whole system was melting. That was actually the day after the Obama victory in 2008. And she sort of let it be known that she wanted some kind of briefing. She was there to open a building. And so one of the professors who I interviewed for the book kind of had to prepare a presentation and take her through it. And she kind of left the conversation saying, well, this sounds really bad. If it was so big, why did no one see it coming? And of course, this is really the question that I was asking in relation to my own business, and a lot of us were asking that question as well. And there was a letter from the British Academy to the Queen, because of course the story made news headlines all over the place, not just in the UK but in Australia and Canada and places like that. The answer she got, was, I didn't think was particularly good. I don't know what she thought. I guess we'll never know now, because she's no longer with us. But I also thought it was quite interesting, because she'd been the Queen for since 1952. So she'd seen quite a few booms and busts in her time. And, I don't know if she reads the papers, she gets government briefings every day. She was reputedly very keen on making sure she had all the detail. And so she probably thought that, well, actually, you're missing something. I don't know, but we will never know. I just thought it was a good way to set up the book, because that's really the key question that we were all asking at the time.
So let's talk about where you see things are at today. This is a podcast you did about a month ago, so still obviously fairly recent.
Yeah.
And what you're suggesting, well, I'll let you explain what this chart is showing, and then along the
this is,
you can tie in the power land.
Yeah, indeed. So this was in a webinar that we did for some of our subscribers. And it's a fairly kind of stylized diagram of the cycle in action. And I replicate this in my book, and I use it kind of as the organizing principle for the structure of the book. But essentially, an 18-year cycle from start to finish involves roughly 14 years of expansion and 4 years of kind of peak, crash, and recovery. And the expansionary 14 years is really divided into a first expansion of around 7 years and a second expansion of roughly 7 years, interrupted by a relatively short mid-cycle recession. Whereas the 4 years peak, crash, and recovery is a really significant economic recession stroke depression, when the banking system is under pressure, property prices are falling very significantly, government efforts to stimulate the economy take much more effort. Whereas in the mid-cycle recession, these things tend to work. The banking system is fine, and so on. But overall, you have a relatively stable structure to the boom and bust cycle. And it's been going on in the US, as Phil documents in his book, as you've mentioned, The Secret Life of Real Estate and Banking, since 1800. It's probably going even longer in the UK than that, because, obviously the US was essentially formed after the War of Independence. And the only things that have really interrupted the cycle in all that sort of 220 plus years of history are the world wars. And so when, the entire global economy is directed towards sort of fighting each other, there's no real room for other normal economic activity. But once you get past that, the cycle historically has resumed. And we are in the latest iteration of it. Obviously, the kind of crisis of the last cycle was in 2008, 2009. And that was in this kind of 4-year period of crash and recovery. The current cycle started around 2011, 2012. There's no single day when a cycle ends and starts. Now, if you knew nothing else about the economy, but you just saw this chart, you'd say, right, given this, we would expect a mid-cycle recession to be around 2018, 2019, 2020, that kind of time frame. And the global economy was indeed slowing down around that. And now people talk about COVID, but actually things were slowing down in 2019. And so we had the mid-cycle recession pretty much on time. It was exacerbated by COVID. I actually think COVID meant that the recession was shorter than it would otherwise have been, because the amount of stimulus that governments pumped into the global economy at the time was so enormous that it just kind of pushed them back into growth again. You then say, right, 7 years on for the mid-cycle recession, you would expect the next peak, and that is around 2025, 2026. Historically, we know the 2 years into the peak tend to be the most kind of manic in terms of speculation, in terms of people, trying to buy things in order to realize a capital gain. You get a lot of different things which indicate, things going over the top. As I've said here, the world's tallest building. We can go on to why that might be. And then things eventually go over the top. There's too much leverage in the system. It can't take it anymore. And then you get the major kind of crisis. And that's the crisis that brings down the banking system. Businesses are starved of credit. businesses employ most people, therefore there's a lot of unemployment, et cetera, and it takes a long time to get through that.
So I want to just bring some clarity to our audience, and then I want to go on both sides of your thesis and sort of walk through that with you. So what I'm seeing here in this graphic, again, it's August 2024. So what I'm seeing based on this graphic is you're suggesting around what, Q2 of 2026 is when things top out?
I mean, I'd like to say that I can tell you the date exact to the time, to the hour and the minute when it will be. No, I mean, it's a zone for which to start kind of preparing and thinking through what you might do if that's the peak. Is your portfolio protected and so on? Whether it's Q2, Q3, Q4, whether it might actually be a different year. The cycles can elongate or shorten historically. I can't say now, but if you're prepared for an eventuality, it probably doesn't matter if it's Q2 or it's Q1. And I haven't changed the timing. I mean, I created this graphic back in 2016, so we were in the middle of the first expansion, and all I've done to change it is I have moved that yellow dot along the graph. I've done nothing else to change it. I haven't changed the dates. I haven't changed that. Now, I think it's sort of, I say this, probably I'd sound fairly hubristic, but I think it's kind of bloody good to have this sort of structure. And I'd been talking about it since 2012, but to have this sort of structure and this graph since 2016, to have this sort of thing going, and it sort of seems to be repeating on time and gives people a sort of framework within which to prepare. I think it's relatively impressive, if you don't mind me saying.
No, so I want you to know, so we go out, we develop and build self-storage, and this graphic and your guys' thesis is actually helping us make some decisions about whether we should be setting up our assets to sell or not. So if you don't mind, what I'd love to do is,
of course,
you kind of, maybe we'll do like a personal coaching session here today, knowing that we've got, let's just say 5 or 6 self-storage assets, and knowing that, and some of these are still in construction, they're not fully developed, but knowing that, like, when would you say, hey, Chris, here's what I would sell based on what I'm going to share with you now, because I want to dance on both sides of your thesis, and then let's walk through this together. And here's what I mean specifically is, this is from the St. Louis Fed, and over the last 15 times that the Fed have cut rates since like the mid-1950s, 11 of those times, shortly thereafter, there's been a recession. You can see here, they cut, recession, cut, recession, cut, recession. The only times, the 4 times that didn't happen is because employment was still good. It was still strong. It's not today. In the last year, we've seen actually a 20% increase in unemployment. So that's not good. The other piece that I will share, though, on the other side of the coin, well, actually, let's dance into this too. On page 189 of your book, you say, hey, one of the keys to Mania is you see a huge increase in construction. This shows, 5-unit or more multifamily construction decreasing dramatically as of late. We look at construction job openings. Those are decreasing pretty dramatically as of late as well. So there's not as much construction out there, even though we've got the big infrastructure bill, big data centers going up. So that's one side of the thesis, Akhil, is, hey, is this thing maybe collapsing sooner than we think? The other side that I want to get your take on, and again, this is from the St. Louis Fed, if I can share this, you've got $6 trillion, yes, with a T, $6 trillion in money market funds that could still be deployed into assets. You've seen the Federal Reserve take $2.2 trillion off their balance sheet so they could, redeploy QE, if you will. If things start to go sour, they start to cut rates. They're going to make. So that's my dancing on both sides of your thesis. With all that being said, how do you extrapolate from there?
I mean, the banking system is changing. On the money market funds, I mean, the banking system is changing quite significantly this cycle. I mean, it's, the banks are very heavily regulated. They're railing against, what they can do. I think this is one of the factors behind Trump's election in 2016, is he promised to deregulate. So the kind of Wall Street lobby was, I think, behind him more so than Hillary Clinton. But nonetheless, you get much more through the shadow banking system and so on. And there is a lot of cash lying around in places that are not, not banks. I mean, it's obviously going to be very significantly in funds if you can earn 5 or 6%. I mean, you don't have to take any risk, and you get that sort of return. When they do start reducing rates, which they've said they would, I don't know how. To be honest, I'm not sure they're going to do too much. I think people are expecting it to go down to 2 or whatever. I don't think so. But it will come down a bit, and some of that money will come out and it will go into other assets. I feel I don't. The data is, I think, a bit complicated, but I feel there is quite a lot of money sitting in private equity, sitting in other places, just waiting for opportunities and waiting for the chance to pile money in. And maybe there's some fear about a slowdown and so on. But I do actually think that maybe there's some uncertainty around the US election. But I think there's just kind of quite a lot of money waiting for the opportunity, and I think that will push the cycle into overdrive. If I'm honest. Now, in relation to, you can bring up the interest rate graph.
Yes.
Look, I mean, so the observation is correct, and I just want to add, by the way, that the one of the reasons why interest rates come down into recessions is because it coincides with key points in the real estate cycle. So understanding the real estate framework gives you an advantage. You can explain this kind of graph. Now, I don't personally think that that the Fed will reduce rates all that much, and there's even the possibility that in a year or so they'll start raising them again. And so you might get a situation a bit like, the kind of mid to late 80s where interest rates came down and they went up. Now, obviously, this will be a slightly more truncated time scale because they may only come down for a year or so and then they go back up again. But the overall thesis is correct. I think the reality is that the Federal Reserve and other central banks went a bit bananas with their raising of rates. And probably if they'd been a bit more measured about the whole thing, we would be in a situation where they'd got to a level, they'd been stable for some time, and then when things started to really slow down, I think they would start reducing them, and probably it'd be too late by then. I suspect some of this is a little bit kind of motivated by wanting to be nice to the next president, maybe a new person. And and we've seen this in the UK. As soon as the new government's in place, there's an interest rate cut. I mean, it might precede the election, but there'll be probably a few cuts after the election as well, and that it gets things going in a way that's very helpful and so on. I mean, people talk about central bank independence, but they are ultimately political creatures, and they have to be aware of the politics. So I think your overall observation is correct. I just think the timing there'll be a bit of timing that kind of finesses the forecast, and crucially, that timing is related to where we are in the real estate cycle.
So thus, what I'm hearing you say, and I don't want to put words in your mouth, but you think, hey, Chris, they're going to cut some rates. There's still a lot of capital out there to go into assets, because I know also within your guys' newsletter, for people that may want to subscribe, you've talked about typically years after the elections are really, really strong in the stock market.
I know. Well, actually, the years after the election are very difficult because all the new government gets in all the kind of crap. I mean, Trump is not he's not that sort of character. He's not. Look, with all due respect to your viewers who might be a supporter, he's not interested in governing in that sense. He just wants to, I mean, he's a real estate guy. He knows real estate, and real estate guys want lower interest rates. They want lots of bank credit, and they don't want any bad news. And so a Trump year one is going to be, I think very strong tax cuts and so on. Very strong from a kind of speculative point of view. From the point of view of the overall economic health of the US and so on, I think both candidates, but I think Trump in particular is going to be, in my view, fairly disastrous. But the pain will be at some other point. Kamala Harris, again, probably will feel the need to, overcome the fairly understandable skepticism about her candidacy in the first place, and so probably will want to see some pretty stimulative policies, which they might not focus on the same things, but I think the effect will be similar. Like in previous situations in US history, the government would get the first year was to get all the kind of crappy news out the way and do all the difficult things, and then year 3 is when they really start pumping stuff into the economy to get it really going in time for re-election. You'll see that as well. It just might be in the middle of a real estate crisis, which will make it more difficult.
Yeah, and I apologize. I think you guys said it was years that end with 5, according to Gann, were typically pretty strong rather than the year after an election. So if you want to correct me there, please do so.
No, that's right. Yeah.
Is that accurate?
That's accurate, yeah.
Thank you. So I think what's challenging, though, for some people to maybe fathom is the right word I'm looking for, is that, I look at gold, all-time high, markets near all-time highs, housing at all-time highs, and yet, according to what you're sharing, you're like, hey, Chris, we still got another maybe 12 to 24 months of this thing continuing to just take off and skyrocket, yes?
I mean, but that's cycle history. I mean, there are very few cycles where things aren't in all-time highs before the peak. I think if you look at the US stock market back to 1800, I think there has basically been one cycle in 220 years where the stock market has failed to achieve a new high at the end of the cycle compared to where it started, i.e. the previous peak. It may not always be the case with housing prices, but housing is a bit different in the sense that it's very locational. It can, it's subject to demographic changes. It's subject to what's being built, and so on. None of which, so it might in some areas house prices may not get to the previous highs. If you had a massive boom in some small town in California into 2007, which then collapsed and then everyone moved away, you're never going to get back to the same highs. Similar, you could say you saw that in places like Michigan and Detroit and Michigan and Pittsburgh and so on in the 70s versus now, because people have moved away. So there's some, you can't be too generic about property prices, but in general, asset prices get to new highs with each successive cycle.
Wow. So with all that being said, and again, we're not going to hold you to this, but just to have some fun, if you were to coach our firm and say, hey guys, here's ideally when you'd want to sell those real estate assets, what would you share?
Well, you want to be selling through the winner's curse if selling is part of your strategy, because you will have lots of motivated buyers. You hopefully have a lot of buyers they can bid against each other, and they will crucially have lots of financing behind them to buy it. And the more you get into that kind of phase of the cycle, the more kind of, shall I say, brainless decision making is going on, and you want to be a beneficiary of that. You don't always have to sell your assets at the peak of the cycle. They're high quality assets that they're real estate related, and they're earning good rents and good revenue, and they're protected, and there's a margin of safety, and you can kind of continue servicing your debts if you have any, and they're in good locations, or they can be repurposed or whatever. You don't have to sell. You can just ride out the crisis and wait for the recovery. I think the crucial point is, what you need to do either thing, either sell at a high price or be prepared to kind of, to benefit from continued rents, but knowing that you won't have to refinance at a very inopportune time.
Thank you.
So yeah, if selling is a strategy, next couple of years would be a good time.
I just want to share this with you because I know that you and Phil are big into dates and sort of, I don't want to use the word coincidence, but for lack of a better word, I will. But this tweet that came out July 17th, 2007, SPX tops, July 17th, 2024. We had this mini correction, full recovery. September 18th, 2007, rate cuts. September 18th is going to be the same in 2024, roughly therein. We're going to have the next Federal Reserve FOMC meeting. And then the thing just cratered. Thoughts on this?
Yeah, 2 + 2 = 17. So, I mean, the Twitter is full of, people seeing stuff like this. I mean, you can see patterns. I give you the answer to that in my book. So basically, at the peak of the cycle, real estate, home building, and other stocks are already on the way down, whereas the broader market is going up. We're not in that situation.
So looking out into, let's just say 2026 and the crash, if you will, that's coming, what do you believe is going to precipitate that? What should we be looking for to know, like, okay, things are about to get bad?
I'm afraid I can't answer that. I think I would, and this is not a gratuitous sales pitch. I think if you are really wanting to follow that, you need to be a subscriber, because I can't say now. But almost by definition, it's something that's going to come out of left field. It may not even be in the US. In fact, it's probably likely not to be in the US. It's related to, it's obviously involving some kind of speculation in something related to real estate. It might not be actual kind of residential subprime kind of things that it was last time. It will necessitate some kind of sell-off, which will cause people to panic. Central banks will intervene. That might calm things, but actually it will only be the calm before the further storm, etc., etc. It could be related to private equity, often is. It could be related to crypto. That's a new thing this cycle. We've seen in relation to Silicon Valley Bank, which that was an example of a banking crisis that wasn't, because it was the wrong time in the cycle. But we know that there are a lot of organizations within the global economy that aren't managing interest rate risks particularly well. It could be something related to that. It could be related to maybe a major energy company that has got a lot of cash and they've speculated and they can't fulfill certain obligations, et cetera, but because the use of collateral is such that it causes a chain reaction. I'm afraid it's very difficult to predict what it will be, but I know that there will be something, and I know some of the signs. And I will write about it quite regularly. It's just that it would be wrong of me to try and speculate right now.
Understood.
I think we have to follow our work.
Well, we appreciate you being that candid. I do want to share it this way then. Maybe there's another way to ask the question, is the fact that this is the commercial real estate report. Scott Pelley, I thought, did a really nice job in a fairly recent interview with Federal Reserve Chairman Jerome Powell. And he asked him, kudos again to Scott Pelley in regards to commercial real estate. So I just want to play this clip for you and then get your reaction, because there's a lot of real estate executives out there. I mean, big time execs that are saying, hey, we're going to get rid of probably 500 to 1,000 regional banks due to this CRE crisis that's about to come, with $2.4 trillion coming due over the next 4 years. So here's the clip. We'll give you a chance to react.
Of the pandemic, the value of commercial office buildings all across the country is dropping as people work from home. Those buildings support the balance sheets of banks all across the country. What is the likelihood of another real estate-led banking crisis?
I don't think that's likely. We looked at the larger banks' balance sheets, and it appears to be a manageable problem. There's some smaller and regional banks that have concentrated exposures in these areas that are challenged, and we're working with them.
You believe it's a manageable problem?
I think we're
not going to see bank failures across the country as we did in 2008.
I don't think there's much risk of a repeat of 2008. Certainly, there will be some banks that have to be closed or merged out of existence because of this. That'll be smaller banks, I suspect, for the most part.
Your reaction, sir?
Yeah, I mean, I think Ben Bernanke said something similar, or Greenspan said something similar in the 2000s about, there's not going to be a crisis. So they can't see the end of the cycle. But I think he's talking specifically about a very small, well, not very small, but a contained part of the commercial real estate market, which, yes, certain banks are exposed to, and which now there's a lot of consolidation, other things going on when you get problems in certain segments of the market. And the reality is that I think he's right. It is contained. I mean, we've seen it with Silicon Valley. We thought there would be, the headlines from this time last year was going to be this is going to be a worse crisis than 2008. I mean, I think it was July 2023 that these sorts of headlines were coming out. He didn't lower rates, but they provided sort of liquidity and so on, and things were able to kind of move through it. But the problem is that ultimately it's falling land prices at the end of the cycle, which kills the entire system. And in some ways, Silicon Valley Bank, the kind of LDI issue in the bank in the UK in October 2022, the stuff that we've had recently, the stuff around crypto, I think is slowly building a sense of, let's say, confidence that they know how to manage the system. And you need that towards the end of the cycle. You almost need people feeling they know how to manage the economy. So this is kind of a marker on the way. But I don't think it's the thing that's going to precipitate the crisis. It's a bit like the 1920s. You had agricultural loans that were underwater, and that was, agriculture then was, half of the US economy. They were underwater for pretty much the entire decade after the collapse in commodity prices, I believe in 1919 after the First World War. But the US economy was able to deal with them. But obviously during the Great Depression and so on, when things had come down at the end of the cycle, all those loans were totally underwater and defaulted, et cetera, et cetera. So it's not that the banking system can't muddle through for some time. It's not the thing itself that's going to precipitate the crisis. The thing that's going to precipitate it is something that we as yet don't know. And my feeling is it will probably not originate in the US. It may well originate outside, but I don't know. We may not even know it. We might see the first consequences of it properly in the US somewhere, in a place that you wouldn't really predict would be the epicenter of that.
Even though you don't know, I'm going to ask anyways, just to get your assessment on it. Do you think it is going to be potentially either China-based with what happened there with Evergrande and what's going on with these basically empty cities, or is it going to be maybe Saudi Arabia with this giant project that they're doing that
the neon? Yeah. I think China is enough still closed off from the rest of the world that it won't. So the Chinese property market has been having issues since 2017 when the authorities basically, I think, rightly decided that they didn't want, people using property as, speculative assets, or I think there was a genuine desire to diversify the investment products that people can put their money into. And real estate shouldn't be the sole thing. And prices were too high. It's creating problems as it does. I mean, this is the source of inequality in our economies, etc. The Chinese didn't want to follow that route. I think it was a smart decision, but it causes a lot of pain and it causes a lot of very significant headlines. It's not a new thing. It's been building up and up. I think with US interest rates going high, some of these large Chinese companies have US dollar denominated debt, etc. It creates problems. Their product, i.e. Apartments, are not growing in value. They're falling in value because the government is deliberately trying to do that. But nonetheless, the repercussions for the rest of the global economy have been fairly limited. So I don't think it's going to be China. Saudi Arabia, Middle East, yes, speculative boom going on there. They're going to have trouble for sure in the coming years. Whether they're big enough to precipitate things globally, I don't know. It's a possibility. We've had this issue in Japan with speculation, but this was kind of the carry trade. It's slightly different. But there are lots of things going on in Japan. It might be somewhere in Europe. It might be Germany. Germany didn't have much of a boom last time, but they've had a pretty significant, and they're having, they're in an economic slowdown at the moment, but property prices are very high and they're not used to the kind of boom bust nature of the property market potentially. Who knows? It's going to be in a sort of fairly significant economy where there's been a fairly significant boom, and people have got complacent and they've borrowed too much, and they can't kind of continue to service it. They have to start selling collateral. That pushes the prices down of that collateral, usually high quality for everyone. Other people start to sell. There's a chain reaction. Banks withdraw lending from businesses that would otherwise perfectly healthy, a bit like my family experienced. And the problem is the central bank interventions calm the markets for a certain amount of time, and the whole thing breaks open again. And then in addition to problems, you get the sense that the government, in fact, doesn't know what it's doing or can't sort it out, and they get a full-scale panic. And that's, I think, really it's sort of it's partially kind of sentiment as well as, you know, economic fundamentals being quite negative as well. And we haven't had that situation so far, which is why Silicon Valley Bank, the carry trade, the LDI hasn't created the problems that people expected at the time.
When I see all the money in the money market funds, the fact that, you know, the Fed could reinstitute QE, I can see how, okay, we could actually see them step in to try to save the day, if you will, and then it just crashes and burns. Now, I know one of the things you talk about in your book, and Phil does as well, is, hey, the beginning, the cracks in the sand, the cement, if you will, begin when land prices start to go down. What are some of the metrics that you follow, or what are you looking at to realize, okay, land prices are starting to go down, I need to prepare?
Well, it's quite hard to get land data. So maybe you have a source of that. You can tell me when land prices started to go down.
Hey, by the way, if you want to jump into the corruption of economics that you guys talk about, please do.
Yes, Well, we'll come to that in just a minute. But you tend to, I mean, the property, you know, prices for residential real estate might continue to go up, even though the land, you know, the actual underlying land prices starting to slow down or fall. And then you start to see a lot of slowdown in the market in terms of people just not being able to afford to buy something. And I don't mean because interest rates are high, it's just that the prices of, you know, what sellers want is just a bit too high. It's not coming down. There's a slowdown in the market. Now, you might say, well, this is what's happened in the last couple of years, but it's been for a very specific cause. It's, you know, because of the Federal Reserve going crazy. And I think everyone's just been basically waiting for interest rates to come down. And then you get a bit of a chain reaction. So you kind of start to see that, you know, real estate stocks are falling because, you know, analysts and for those companies are starting to see that the profit margin for those companies is going down because prices are no longer rising, and margins have been squeezed and there's no growth in the business and so on. And so they mark down the stock price and they start to fall, even though the broader market's going up. So I think those are some of the metrics. I lay out, you know, what I look for in the book, chapters 12, 14, and 15 for this kind of part of the cycle. Now, why do people not measure land? Now, so we've had this boom and bust economy since, you know, 1800 in the US, longer. And it's also an economy that over time gets more and more unequal. And that's because the ultimate asset in an economy is land. It's the most valuable asset. It's the asset that's, you know, totally fixed in supply. You know, land in good locations, you know, you might find it hard to believe in a country like the US, which has super abundant endowment of land, but, you know, it's not land in the middle of, with all due respect, in the middle of Oklahoma. It's land in Oklahoma City or in New York City or in Miami or wherever it is. And that's fixed in supply. That's where people are. That's where businesses are. That's where you make money. That's where you have you can enjoy your life. That is very unequally distributed. And it's also the value of that land is not down to any individual effort. It's down to collective effort of investment and natural resources and, you know, nice parks and so on. And so a 19th century economist by the name of Henry George, who I'd actually come across when I was at school, had basically pointed out that it's mad for us to be in this situation, to be experiencing this kind of boom and bust cycle and this inequality when, you know, people are taxed for their profits and their wages when they're actually adding value to an economy. But all this unearned kind of wealth, this wealth that is due to collective investment or natural advantages, is privatized basically. And that, he said, that should be returned to the public. That should fund public services, and you should free the market to do what it does. Anyway, long story short, a lot of landowners in the UK and the US didn't like this idea because, you know, that would basically cut off the gravy train for them. In the UK, the Liberal government in the early 20th century tried to pass a measure to enact this kind of fiscal reform, which got defeated by the House of Lords, which of course are full of landowners. In the US, George was very popular. He almost became the mayor of New York. He was very influential on, you know, many people in Woodrow Wilson's cabinets and so on. And so what happened was that university faculties, economics being a very new discipline at the time, they changed the discipline from the Adam Smith discipline of considering 3 factors of production, land, labor, and capital, to one that just considers labor and capital. And they somehow, by hook or crook, and it's documented in this book called The Corruption of Economics, after which my chapter is named, by hook or crook, they got land taken out of the economics discipline. So it's not considered as a factor of production, such that you could never implement or diagnose the boom-bust cycle, never implement Henry George's solution. And so it's never really been proposed seriously on any major platform in any major Western country ever since, which is a real shame, because, you know, we have experienced 2.5 centuries of boom and bust. Inequality is a very salient political issue. You know, young people can't get on the housing ladder. This is the reason. It creates enormous social problems. It's basically a very unfair way of doing things. And it leads to a lot of unhappiness, a lot of misery. And at the top of it, you get a sense that there are people there that are not really contributing to society and to the economy, and are taking away the lion's share of the gains. Anyway, because land was written out of economics equations and the discipline, no one bothers to measure land in terms of prices. And so it's quite hard to see the boom-bust cycle in its purest form for that reason, which is a great shame, because it would tell us a lot. Maybe it's not a great shame for me, because then I can, people can subscribe, and I can say things and look very smart, and other people wonder how I do it. So that maybe every cloud has a silver lining. But I came into, I didn't mention this at the beginning, I came into my study of economics actually to think there must be a better way of organizing our affairs, that we don't go through these, really, really heart-wrenching crises at the end of the cycle that creates so much misery, and also that we don't have societies that are increasingly divided between those who have and those who have not. And just as a final point, I know I've gone on for a bit, you see the problems in their starkest condition in the places where land prices are higher. So the enormous homelessness you see in San Francisco, particularly during the Silicon Valley boom of the 2010s. In London, really enormous high price house prices. When one sign of land prices going up in a city, you start to see a lot of homeless people on the streets. And sometimes it's hidden because there are social programs and so on, but you see people begging and so on. It's a sign. It's actually endemic to our system. It's not because people are lazy and so on. Sometimes they just have no alternative. And fundamentally, it's because of the unequal distribution of land.
Akhil, just before we came on the air, you posted an incredible clip of Peter Thiel on Twitter. I mean, it was an amazing coincidence. I'm going to play that in a minute, but I do want to just back up for a second. I think really one of the real powerful things I want to share with our audience, when you read this book, and this is his partner's book, Phil Anderson. So when you read these two books, what's been so powerful, Akhil, for me is that, again, I do not want to be a lazy thinker, but now I cannot unsee what I've seen thanks to you guys, right? So it's so powerful, because now I'm taking in this data and this information through a new perspective that I can't unsee. So it's just been incredible. All right, so this is a clip you just put up. I honestly don't even know everything it says, because it literally was right when we were going to go live. So I just want to play it and then give you a chance to comment on it. For people that don't know, Peter Thiel, multi-billionaire, big tech name, co-founder of PayPal with Elon Musk, has done extremely, extremely well. And where was this at, by the way, Akhil?
I actually don't know. That's a good question. I just saw it on X last night, and I don't know. I should find out. So I should write about it, actually.
It seems fascinating. So here we go.
I always think the more concrete economic thing to try to focus on are things like housing, real estate. I'm always very partial to the theories of Henry George, the late 19th century economist who was considered socialist in the late 19th century. In the early 21st century, is considered libertarian, sort of a symptom of how much our societies have changed in some ways. But the rough thesis is that the single thing you need to always pay attention to in an economy is distortions around land use, property, And if you're not careful, you end up with a sort of runaway effect in which the people who are the winners are not the technologists or, various people, but people who sort of won the housing lottery in one way or another. And that this leads to sort of a lot of very strange dynamics. I always think
I am so happy that this was posted right before this interview, because I cannot wait to hear that is stunning coming from a tech guy that, hey, you got to watch the land, right?
So, yeah, now look, I wrote an article probably back in 2017, and it was a Bloomberg article, and it was Peter Thiel complaining, because he's a big venture capitalist. He was complaining about the really ridiculously high rents in San Francisco. And he was pointing out that any investment that a VC does into a startup is essentially going straight into the landowners around San Francisco, because you're essentially paying for a bit of tech, but you're paying for developers' time. And developers' time, they need to be paid in a way that they can live and collaborate in San Francisco. And most of what they're being paid for is to afford their rent, so they can be in that location. Food and other things is a very minor part. So essentially, he's talking about he's quite aware of the fact that most of his VC money ended up in the pocket of landlords, which is basically the point that I was making a few minutes ago. Ultimately, it all comes down to location. It all comes down to land. And so I think he's kind of woken up to the fact that actually there is a better way of doing things. And I'm not sure that George was considered to be a socialist in the 19th century. He effectively launched the progressive movement. So he was anti-monopoly. He was anti kind of people taking out of the economy stuff that they hadn't earned, and so on. I'm not sure that. I mean, socialism is really more you collectively own the means of production. It's actually possibly the most misused word in the United States. I follow US politics quite closely, and the number of times that people misuse the word socialist is quite incredible. He's right to point out that actually the other side of George's solution is basically freeing the market to do what it does. So you create a more free system. You don't need so much government intervention because the market sort of corrects itself. You can't, incidentally, just on that, you cannot be libertarian without a Henry George solution. It's simply impossible. This idea of absolute ownership of property, regardless of whether you deserve to own it or whether, how you've come by it, et cetera, how you accrue the benefits, it's absolute recipe for disaster, and it never survives a crisis. So I think, it's to his credit that he's sort of woken up to that fact. I think there's one problem, though, that he has, and that is that we're not just talking about land. We're also talking about digital lands. The entire internet is a you can argue to what extent Google has contributed to that, but ultimately it's based on public investment in all the infrastructure, all the population being online, and government facilitating that with skills, and so on and so forth. It's a vast collective enterprise. All the content that ChatGPT is scraping to develop its models and so on. It's a vast collective enterprise, and that is becoming increasingly privatized by a relatively small number of companies like Google and Apple, and so on. And so Henry George's theories in the 21st century would apply to that as well, which is one of the reasons why the Mag 7 or the FANGs or whatever you want to call them are so valuable. It's not because they produce, they obviously produce wonderful products, but the value of their stock market capitalization is now increasingly down to their ownership or enclosure of what is ultimately common, the digital commons. And so they are replicating the sorts of things that colonial powers replicated in the US and North America in the 17th century and in Australia and so on. It's exactly the same sort of process. So we're basically taking our flawed system into the virtual world. And so I'd be interested to know what he thought about that as well. I think maybe if he reads chapter 4 of my book, where I go into some of this, he might want to think also about that too.
Be fascinating to see as we colonize, Mars and or the moon.
It's the same thing. We're doing the same thing. The violation of the Outer Space Treaty of 1967, it was effectively giving ownership rights to bits of moon and asteroid and so on. I mean, I think we can probably now intuitively see that there is no inherent, just because you arrive in a place first, that doesn't really give you the right in perpetuity to the benefits of that, regardless of how you got there and so on. In the same way that people might have thought, kicking off the natives and claiming a piece of land in North America or in Australia or something.
With what you just mentioned about Henry George, I want to give you just a chance also to speak about Phil's citizen dividend, where he says, look, if we did this differently, we could get rid of all taxes and really don't even need it.
Yeah, we would. Yes, and eventually we would pay into. So the idea is you collect this sort of unearned income into a fund, and that fund would pay for infrastructure and making our society better off and doing all that kind of stuff. And actually, that would be the measure of whether a government is good or not, is whether it increases the rent, which it then collects back into the fund. There would be no kind of question mark about whether a government was effective or not. It's just basically they're making the right investments, which and you can measure that very precisely. There would be a surplus, and that would be distributed back to the citizens as their sort of birthright for being part of an economy.
And I think one of the powerful analogies that you and Phil have used is what Alaska does with oil, right? And that's a natural resource. So really powerful concept. If you want to comment on that.
Yeah, no, it's, Alaska has got a lot of oil resources. They have basically collected the royalties from that and put it into a fund. And every year there is a payment made to every Alaskan citizen out of that. And the same thing happens in Norway. I think they own 1 or 2% of the entire global stock market. They own, swathes of central London, and they took the rents from the North Sea oil, which they found in the 70s, and have put it into that, and they have no issues about infrastructure and so on. The UK, which actually had an even larger endowment of North Sea resources, and they did consider a sovereign wealth fund, then they didn't do it. And now, we're in a situation in 2024, 50 years after exploiting all these amazing resources, where we can't, seem to find money for our National Health Service and investing in roads and rails and so on. And it's a massive wasted opportunity, because we'd have had an even bigger wealth fund than in Norway.
Akhil, I want to be respectful of your time. I did want to jump into chapter 3 in your book about infrastructure. Maybe we'll save that for another conversation. For people out there that piqued your interest, again, I would encourage you to go get The Secret Wealth Advantage. You can get it at Amazon. We covered a lot today, Akhil. Is there anything else that you want to share that I haven't touched on?
I mean, there are many ins and outs of the cycle and many reasons why it happens and why people don't see it. So we'd be here for another few hours. But I think the main thing is I don't believe that we're heading towards a recession just now. I believe that the next couple of years will be pretty big. I believe there's a lot of credit and a lot of liquidity floating around. So, I think you want to consider, all of your decision making in relation to those dynamics. Now, the timing is not necessarily precise. The 1920s, the land market peaked in 1926. The overall kind of stock market peaked about 2.5 years later. Commercial real estate actually did really well in the final 2 years, building skyscrapers in Manhattan and places like that, all these brilliant Art Deco stuff, but a lot of those were empty at the time they were built. So there are things that you might seemingly alter the timing. And I think, my suggestion is understand the framework properly. Don't do anything rash. Be prepared for eventualities. Don't, try not to experience too much FOMO if you sell an asset towards the end of the cycle and it still jumps another 30% because someone's crazy enough to have bid for that. You gotta wear some of these things. The main thing is, that at some point the whole thing will come crashing down, and you definitely don't want to be holding assets you're trying to sell, or you don't want to be trying to refinance debt that you can't service at that point, because it will make things really, really difficult and may ruin you financially for quite some time after that.
Very, very well said. If you want to follow Akhil on Twitter, here's his Twitter handle, Akhil G. Patel. And also, if you want to find out more about There's newsletter. I'm going to give you a chance just to comment on the newsletter you guys put out and the great content if people want to go sign up and be a member.
Yeah, so we have 3 different newsletters, or 3 different levels. There's a free property cycle investor newsletter which comes out every week. It's free. It gives you an update on where things are in the cycle. It comments on news and how to understand the cycle and sort of just kind of follow along. And if that's you want to just scratch the surface. If you want to understand the cycle in a bit more detail, you can also sign up to our Boom Bust Bulletin newsletter, which gives you a monthly essay on various aspects of the cycle. We talk a bit more broadly about commodities and the stock market and various sectors. We delve into different countries. We did a piece on India earlier this year around the time of the Indian elections. And if you want to be a full subscriber, you can be a PSE subscriber. That gives you all of our forecasts. It gives you weekly updates from Phil or me. It gets you involved in if you want to sort of understand a portfolio of things that we're looking at, gives you stocks to watch. And basically all of our knowledge is in that top level newsletter. And I'm pleased to say that you are one of our subscribers, Chris.
I'm pleased to say as well. It has been very, very insightful. So again, I would encourage you to go check it out. PropertyShareMarketEconomics.com. I think you will find a lot of value in that. Akhil, it has been just a really honor and a joy to have you on. Stick around. I'm going to end the stream, but I do want to just share one more thing with you. Again, this is the Commercial Real Estate Report. We're empowering you to build generational wealth with real estate.